Let's get to our market recap. And really on Fridays, we wrap the week. And what that means is we look at the long term and how the picture has changed Friday to Friday. What's the evolution in these trends? And the S&P certainly finishing in a position of strength today, right? The S&P up to around 3271. So a decent way to finish the week. It wasn't as high earlier in the day. It was really finishing more, or midday was around 3220. And then you can see it rallied, really accelerated into the close. So certainly some optimism going into the weekend here. Interesting to note where the movements were. If you go outside of that large cap growth space with the overweight in tech, communication services, pretty much everything else was kind of flat to down, if not down in a pretty meaningful way. Small caps finished the day down 0.7%, mid caps down 0.6%. Again, earlier in the day, these were all down a lot more. A lot of that movement came in the last half of trading for sure. The NASDAQ 100 certainly leading the way higher, with technology the number one sector up 2.5%. So, this week, besides the Fed meeting, which I think ended up just being sort of a non-event, I think everything that they had said has sort of been priced in. There weren't any real surprises there. The tech companies speaking in front of Congress, a congressional hearing. I don't know how much that moved the needle. I think the earnings releases and how we digested that is really the story, and how things sort of evolved going into the weekend here. Let's look at a chart of the S&P 500. Actually, forget that. We're going to go right to the Mindful Investor Live chart list again on a Friday. We like to wrap the week, means we're looking at the big picture trends, how they've evolved. We'll start with the S&P 500 long-term trend following model, and this hasn't changed really since last week. This remains long-term bullish, medium-term bullish, short-term bearish, and the way that's again, the way that I'm interpreting that is the long-term trend. What I think is like the multi-year trend, the secular trend, is based on the weekly PPO using the 21 and 34 week exponential moving averages. That remains positive as long as it's above zero. That's in a positive place. The medium-term trend is defined by the weekly PPO using the traditional settings. That turned positive in May and remains positive to now. The short-term is based on the difference between those two moving averages, sort of the histogram that is part of the MACD or the PPO indicators. That's been bearish just for the last 2 weeks. And again, that just represents that short-term weakness within the long-term trend, which is about how it feels for the S&P overall, as well as for the broader market. Here looking at the daily chart, you can see how we sort of rallied up to finish closing more at the highs of the day. That's where we're at here, around 3270. So just in the short term, just in the last 2 weeks, we've established a sort of mini range, you might call it, between 3,200 on the low side, around 3,280 or so, which was the peak from last week. So, we sort of have this short-term congestion area, which is right about at the June high. So if you think about it, we have attempted to break above the June highs. We have not been able to follow through it. Again, today, we have now closed above 3250. I would want to see some follow through. So again, every time we close above a key resistance level, we haven't gotten the follow through yet. That's what I would be looking for into next week. If we do that, I think that clears the way for much higher highs. The rally going into the close certainly changes the look of this week, finishing stronger for sure, finishing at the high point for the week. Again, not quite eclipsing the finish for last week. The underlying, or the maybe overlying thesis to keep in mind, however, is the bearish divergence with higher highs in the price, lower peaks in the RSI. That really hasn't changed. I think that's still in play. And again, what that tells you is the uptrend is in play. The uptrend is maturing, I guess is how I would think of it. It's not necessarily for me telling you to sell or telling you to go in cash or telling you to get really nervous. It tells you to be aware, similar to what you saw in February. If you want to be really aggressive, you could, take a position, a short position, and then just have a really tight stop for something like that. For me, I'm much more interested in a confirmation, an indication that an uptrend is over. The bearish divergence puts it on my list. The breakdown in price is what tells you it's actually happening. So for me, 3,200 would have to be broken first. And below that, it's really about the 50-day moving average, which lines up those swing lows from July around 3130, 3150 or so. The next chart in our weekly list here is looking at breadth, and this is what I think tells a little longer term story of what we saw today. Today, if you looked during the day, anything tilted toward large cap growth was doing okay to pretty well. Anything else, anywhere else in the style box of the nine quadrants are using, no, it's not quadrants, the nine parts of the box from, growth to value and small to large, pretty much everything else was in the red, midday. And that showed you how narrow it was with the leadership coming from the largest names. The breadth picture, I think, sort of confirms that. You can see the long-term cumulative advanced decline lines in the S&P 500 remaining positive. If you look at the New York Stock Exchange, look at the mid-cap index, look at the small-cap index, they're all what I would consider neutral. They haven't broken above the the June highs just yet, whereas the S&P already has. The S&P is actually broken above the February high. So there are a lot of ways to calculate advanced decline lines. This is how I've tended to do it. And until you see these continuing a pattern of higher highs and higher lows, I think it's sort of a wait and see mode there. We have had a consistent number of new highs in the month of July, and that's wrapping up today. Obviously, we'll start August on Monday. So, if you look at the month of July versus the month of June, certainly an increased number of new highs on the S&P 500, an increased number on the broader New York Stock Exchange. That's all fairly constructive. And as we've talked about before, an uptrend has legs or has the potential to continue on if you have these numbers going higher, because if the market goes higher and these numbers remain muted, that just means it's a small, narrow number of stocks doing all the gains. These lines going higher, these histograms going higher, tells you more and more individual stocks are breaking to new 52-week highs, meaning they're eclipsing their highs from back here, like the S&P has not done. This indicator continuing to go higher tells you it's a measure of breadth, suggesting how many stocks are along with those mega cap names that have already done so, if they're participating in the upside as well. I, said in a public forum, including the show, if this indicator, the percent of stocks above their 200-day, gets above 50%, which it did a couple weeks ago, once that happens, I have to assume that the path of least resistance is higher. I've revisited that many times in the last couple of weeks, and I stand by that. I certainly recognize the uptrend is in place. Now over half of stocks in the S&P are above their 200-day moving averages. That's good. That's what an uptrend should feel like. And if you look back over time, that's what uptrends have looked like. That number remaining above 50%, I think, would continue to validate that bullish thesis. If and when that gets below 50%, that would be an indication for me to revisit that and think about potential downside. So, I think the good news for the S&P is you have breadth measures that are either neutral to positive. You have things like this that have a clear line that you would agree to revisit it. You have clear support levels below where we're at, around 3,200, maybe the first stop on that train. If we start breaking those levels, I think you can start being a little more concerned than you need to be now. Interesting move in the AAII rankings this week. And again, I don't like to drive this home too much, only because I find sentiment is sort of the third in importance. Starts with price, second is breadth, third is sentiment, because price tells me what the market is doing. What are people voting with their capital, with their money? The breadth tells me the characteristics of that and sees if I can qualify what I'm seeing with price by what stocks are actually moving up and down. Sentiment is a little more softer and fluffier, right? This is a little more what people are saying they're going to do. Price tells you what they've actually done. So that's why I put it third in importance behind price and breadth, but it's still an important data point and something that leads me to dig into price levels maybe a little more deeply. So interesting to note on the AAII rankings, the spread between bulls and bears is pretty low. I'm sorry, it's pretty strong to the downside. It's the lowest it's been. The only other time it's been this low in the last 5 years was May, which was sort of this pullback on the uptrend. The December market low in 2018, and the end of the 2015-16 cyclical pullback in stocks. So we're right back at an extreme spread between bulls and bears. So it's over a 2-to-1 ratio. It's kind of 2.5 to 1 right now, bears versus bulls. So bullish votes down to 20%, bearish votes almost to 50%, and in downtrends you start to see 50% readings on that indicator. This is a performance look at consumer discretionary versus staples. I think we've talked about some of these. I don't want to hit on all these, but I just want to hit on a couple key points. This ratio is starting to favor consumer discretionary, starting me to lean, to think about the technology leadership and what would take its place if technology started to taper off. This week certainly saw rotations back into technology shares. This ratio turning back lower, favoring tech over consumer discretionary. Again, until we break above this 1.3 level, which would be a new swing high for that ratio, it's telling you tech is still a pretty decent place to be. The relative performance in semiconductors remains very positive, again, confirming the strength in that bellwether group. This ratio is actually really interesting. This is small caps versus large caps in the form of the IWM versus the SPY, the Russell 2000 ETF versus the S&P 500 ETF. I think it's worth noting this was in a huge downtrend to the March lows, a nice uptrend since the March lows. That changed mid-June when you saw sort of a change of character, a lower peak, and we broke down through trend line support. Since then, what's happened is it's now sort of chopped around, and a lot of measures we would look at. I can't remember if the chart I want to show is on here next. I'll see it in a second, but there are a number of other measures that are sort of choppy to sideways, sort of gives you a number of false breakouts and breakdowns. And I think this small cap versus large, you could arguably put in that bucket. Overall, force me to pick a decision on which way. I would probably say this is leaning away from small caps and into large caps. And I do that because it's a pattern of lower highs and lower lows until that changes. I think it's certainly favoring large over small. But it's interesting to see how it's sort of in this choppy, head fakey kind of environment. The other chart that reminds me of is high beta versus low vol, which I think is on here. Here we go. This is a chart we've looked at. This is the outperformance of high beta versus low volatility since the March 2020 low. This is that pullback since the June market high. You can see how it was favoring low vol as a group versus high beta. Since then, it's essentially been sideways. So it's sort of, an equilibrium point, which again, this is what the S&P has sort of felt like. It had the big run out of the March lows, the peak in June, and now it's sort of been choppy. It's been more range bound than anything. So these kind of ratios, small versus large, high beta versus low vol, I think there's a movement to come here. And I think which way these sort of charts break will hopefully would help you understand that idea of risk on versus risk off and where investors are sort of leaning. I did want to finish off. We sort of hit on that group of charts pretty heavily. I just wanted to finish off looking at a couple non-equity asset classes just to revisit where things are at. We talked about bonds earlier in the week. We had our segment clipping coupons. I think that was Wednesday. I'm not entirely certain which day it was, but we looked in a little more depth. We don't have time to get too much into it, but I did want to point out that TLT remains in a decent uptrend. 10-year yields making potentially a new all-time low here. Really continuing to come in. We're continuing to see lower yields, higher bond prices, and that's essentially across the board. But if the chart of the TLT is the main one I look at, again, when I talk about bond prices going higher, I have a lot of people telling me why that shouldn't happen. And all I try to do is just point at the chart. You can tell me whatever you want about what should not happen. This is what is happening, right? So bond prices are going higher. Until that changes, I have to assume that that's going to go. There is a theoretical limit to the extent of that going up, but we're not there yet, I don't think. Gold is another one, and gold certainly has had a pretty exceptional week with the gap higher on the GLD, and this week really finishing more on the positive side. The GLD was up almost 1% again today. So, as we've talked about, I think as a long-term play, gold, precious metals certainly bears some consideration. Larry Berman on the show yesterday made a decent case looking at an inflation-adjusted gold price as well.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.